Coca-Cola, ticker symbol KO, is currently trading at $61.74 a share. This stock has recently plunged around about 15% from its all-time highs from $73 a share. If we look at the stock over the last 5 years, you can see this has happened a few times where the stock has dropped around about 15% and then is recovered quite nicely in the coming months. Is this the right time to buy? Are they going to be doing the same thing again? Hopefully that's the question I'm going to answer today. So what we're going to be doing is looking at my automated stock valuation spreadsheet to see if KO is a buy using the discounted free cash flow model, comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So yes, as I said, if we look over the last 5 years, they had the pandemic crash. It was $60 a share, dropped 36%. Did take about it took about 2 years for the stock to recover. But this was weird times, as we all know. But if we look here, there has been some points where the stock dropped around about 12%, recovered in about 4 months. Once again, here from the bottom, which was $54 a share, took about 3 months to regain 18%. Even here back in 2023, October, once again, took about 3 months again to increase this 15%. So will this be a similar story? Another reason the stock is well liked is obviously it pays a very nice dividend, 3.14% currently. But let's get into it. So if we put in the ticker KO, this will load all the latest company financials, and then we can have a deeper look. $61 a share, $266 billion in market cap, a PE ratio of 25.64, which is currently less than the market average, which is exactly 30, so that is good news. Earnings per share, $2.41, and a beta of 0.61, meaning it is less volatile than the market, a lot less. Usually anyway, as I said, we've just had a 15% dip. Target price analysts do say it is a buy, interestingly, $74.38 a share. Dividend, 3.14%. That means you'll get paid $1.94 a share. If you buy your shares before the 29th of November, you will get paid your quarterly dividend. Now, is it a safe dividend? Usually yes, but you can see here, 8.4 billion they pay. In terms of the net income, it's quite high, 80%, but in terms of free cash flow, currently it's 500%. They only have 1.6 billion in free cash flow. Now we'll just quickly jump ahead here. The free cash flow number is a little bit lower, or a lot lower, sorry, this quarter or this year. If we go to their most recent earnings, you can see here free cash flow from cash flow from operations and free cash flow non-GAAP were 2.9 and 1.6 billion respectively. Both decreased versus the prior year, primarily due to a 6 billion payment to the IRS related to ongoing tax litigation. So this is not a consistent thing. This is just for this year. Usually the free cash flow is in that 9 to 11 billion. This has been steadily growing, but currently 1.6. So that is why the free cash flow payout ratio is very high. Let's just have a look at the revenue. 46.37 billion. They've been trending up since 2020. This is the highest it has been since about 2013, where they were at all-time highs of 46, 47, and 47 billion. So trending in the right direction, positive growth is what we want to see. Net income, not all-time highs or not recent all-time highs, 10.41 billion, down from 23, but once again, steadily growing up, which is excellent. Free cash flow, as I said at the start, it is down, it is a lot less than expected, around about 6 billion, so it'll be in that 8 billion range, 1.59. You can see that it has been growing, had a big year in 2021. And also if we look at the operating cash flow versus CapEx, obviously free cash flow, the green line here is down, operating cash flow is the blue, down again because of the 6 billion payment, and then CapEx is up slightly. So yes, this is down. Shares outstanding, there's a couple of splits here, so it doesn't really work out exactly, but you can see here that they have been slightly issuing more shares. They've done a little bit of a buyback, buying more shares. It's been pretty consistent overall, so nothing to too worry about. It would be nice if they did buy back some shares, but they are paying dividends and things like that. So let's have a look. Sorry about that sniffle. Let's have a look at my discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. And based on averages, it's actually almost exactly fairly priced, $61.64 a share. So let's have a look at these numbers and see if we agree with them. So first, revenue, we're expecting 49 and about 52.5 billion in the next years. Let's see if analysts agree. They are saying around about 46, 48, so we're a little bit more bullish. Also, growth estimates. Oh, they've changed it here. Where's the 5-year growth? Well, they're only showing the next year of 5%. So, apologies for the coughing. I have a certain virus that will not be named again. So I'll try to stop coughing. But anyway, 46. Oh, that's current year. Sorry, 46 in the current year. 2048. So we are, yeah, maybe we're a bit on the bullish side. We'll bring this down a little bit to about 5%. Net income margins, I'm happy with that number, but obviously free cash flow, 13% is bringing the average down quite a bit. So what we'll do is we'll take an average of these last 3 years, brings us to about 94%, and that puts it at $73 a share, which if we look at the price that I was saying after that 15% drop off, about where it would have been. So that is excellent to see. Next, we'll have a look at the dividend discount model. This currently puts it, we'll increase that a little bit to the current weighted average cost of capital. $68 a share with an expected growth rate of about 5%. If we bring that to the most recent year, yeah, it honestly puts it about fairly valued. Maybe if they keep increasing the dividend, then yes, undervalued slightly, but as you can see here, about fairly valued. Man, I am slowly dying. Okay, next, Ben Graham formula for intrinsic value. I don't think this will like the stock. This is with the low expected growth rate. But as I said, Yahoo has changed this, but 5% in the next year, 6%, it's $31 a share. We'll quickly skip this. Ben Graham does not like this stock. But finally, comparable company model. This is a way of looking, companies looking at similar companies with similar sizes, industries, and we will compare. So first one is, of course, Pepsi. That's a bit of a no-brainer. PEP. Next, Monster, MNST. And KDP, which is Keurig Dr. Pepper. For some reason, I didn't put a glass of water next to me, but we'll power through. So Coke is the largest with 300 billion compared to Pepsi's 250. Monster is the smallest with 50 billion and Keurig 56. Revenue, second highest revenue, 46 billion compared to Pepsi's 90. Monster and Keurig a lot smaller, 7 and 14 respectively. Lowest in terms of growth rate, most profitable, and actually highest profit margins, which is pretty crazy to see. Price to sales, current average of price to sales is 3.06. Second highest, Pepsi and Keurig lower than the market average. Price to book value is around about 5.16. Second highest again, Peg, Peter Lynch's price to earnings growth, it is the highest there, 2.6. EV to revenue, EV to EBITDA, PE, and forward PE, highest, sort of overvalued on all metrics here. Yeah, so it gives us an average of around about $53 a share. If we were to just compare against Pepsi directly, overvalued as well. So comparable company model doesn't really like this stock compared to these. The Ben Graham doesn't like it. The dividend discount model puts it about fairly valued, maybe slightly undervalued, and the discounted free cash flow puts it about $73 a share. Yes, it does pay a very good dividend of around about 3.14%, but is this the good buying opportunity because of this 15% decrease? Right, guys, thanks for watching. Please like and subscribe if you haven't already. Check my Patreon as well if you're interested in using the sheet for yourselves. And apologies for the coughing and sniffling, but I'll catch you guys next time.